First of all, my name is Ed Gilmer. I head up capital markets at passiveinvesting.com. In my role, I kind of handle the debt for all of our multifamily properties and other properties. But today we're going to focus on the multifamily properties. Very interesting times we're in. The last 12, 24 months has been a roller coaster, and I'm looking forward to the day when that's not the case, but we're there. There's a lot of financial uncertainty right now regarding the rest of the year, the next 6 to 12 months. Just so I have an idea, does anybody have any multifamily loans that are maturing or coming up for renewal in the next 12 to 24 months? If you could pop in the chat box and let me know. I want to kind of make sure we're targeting the right audience here. And if you don't, do you have any deals you're buying currently, you're looking at some debt options on? The reason I ask is, in a portfolio of our size, there's always a deal either coming up for renewal, looking at a new deal. So, all right, Craig, he has a floating rate with a cap expiring June 24th. Most of the deals that people have bought the last few years, the primary debt that's worked on those has been bridge debt. Your 2-year, 3-year floating rate deals that require rate caps. And when those rate caps come up for renewal, they can be expensive. The forecast for rate caps is to come down the rest of the year. We were looking at a deal recently for it renews in Q4. The rate cap was a 1-year extension. Rate cap was previously about $1.9 million. That's come down to about $1.3 million in the last couple of weeks with just market shifts. And I expect that to continue. Let's see here. 5 years left, but looking to refinance next year from Paul. Justin, let's see, just purchased using HELOC and DSCR, both at 10%. I hope the deal works out for you. If you have a deal coming up for renewal in the next debt coming up for renewal in the next 6 to 12 months, we're going to go over some strategies there. And these same strategies apply to new deals as well when you're looking at acquisitions. It's an interesting market. The traditional options of your agency fixed rate debt and floating rate debt, those targets change on a daily basis, kind of based on the treasury rates. And treasury rates have been doing this. Traditionally, they're kind of more flat, up and down. The shift in treasuries recently is unprecedented. Hopefully, again, that slows down in the near future, but it's not there yet. So we're going to go over current market conditions first. Like I said, treasuries, most multifamily deals are either SOFR based or based on a corresponding treasury. A 5-year deal, 5-year treasury, 7-year deal, 7-year treasury, 10-year deal, a 10-year treasury. HUD loans are not tied to treasury directly. They're loosely priced off of them. Right now, the 5 and 7-year treasuries are about 360. Last time I looked, those in the last week or two have been 20 to 30 basis points lower. And the reason that matters is when you're buying a new deal and the day you decide to lock on the debt, that can affect your cash flows for 5 or 7 years. So being very strategic about the day you do lock on your debt and finding the day the treasuries do drop, if you're doing a treasury-based loan, is very important. So you need to stay in touch with the outlook on treasuries. There's a bunch of websites you can look at those to kind of keep your pulse on them, your finger on the pulse of the market as well. If you're having a deal that's SOFR based, a lot of the bridge deals are SOFR plus a spread. The SOFR forward curve is the indicator of where that is expected to go. The forward curve is never accurate 100% of the time, but it kind of gives you a guideline of where it's going. Roughly, they expect the forward curve to kind of level off the next 4 to 5 months and then start to drop in Q3 and Q4. I think it loosely mirrors the Fed funds rate, not directly, not corresponding, but it kind of the same trajectory. I believe the Fed funds rate are going to start to be cut early Q3, hopefully, maybe mid Q3. And that'll be good for everybody. debt-wise. Another thing to watch is the jobs, larger macroeconomic indicators. You can watch, CNBC, read a bunch of websites. You can follow articles in Wall Street Journal. I love reading this stuff, learning about the markets and where we're going. We'll look back one day and say who's right, who's wrong. We went to NMHC, National Multifamily Housing Council, has an annual meeting. It was at the end of January in Las Vegas. And that was one of the first times I've heard the word cash in refi. Typically, when you buy a multifamily property, you go to refi, you say, okay, cash out refi. How much are we looking at here? The cash in refi thing was new to me. I was like, you're saying it wrong. It's cash out refi. But given the leverage on deals the last couple of years, you bought a deal maybe 70%, 75%, 80% loan to value. Due to interest rates and cap rates changing, you may now be at a point where you need to put in more cash at time of refi to get your deal to work. Nobody wants to hear that. I think that's going to cause some issues. There's already been 2 headlines in the last couple of weeks where a group in Texas had $230 million of properties foreclosed on because they couldn't refi or restructure their debt. That was a national firm. And another group had several properties they had to turn back over to the bank because their rate at acquisition was about 3 or 4%. Rates went up to about 8%. They might not have had a rate cap in place. I'm not sure the exact details there, but you have to hedge your risk on these large deals. Some challenges in the current market, in addition to rates, pretty obvious there. Which firm in Texas? It was a national. I can Google that and get back to you in a bit. It was like $230 million of properties. It was one of the larger REITs, and it kind of surprised me. The challenges other than current rates, most deals, if you're looking at a bridge deal, you're going to get 60% financing, 65% perhaps, SOFR plus 3.5 or 4%. And right now SOFR is 4.8, 4.9%. So the all-in debt number is pretty high. A way to hedge that, we've done this a couple of times, is you buy a rate cap below the strike. I've gone over this before on a couple of these webinars, but if your lender says, we'll give you a loan of SOFR plus 3.5%, and SOFR is currently, let me pull up today's rates right quick. It's in the high 4s. Let's see. You could cap SOFR at 2%, 3%. Let's see. SOFR is currently term SOFR 4.94, almost 5%. So 5% plus another 3.5. That's 8.5% interest. Most deals, the cash flow is very tight at that. You're probably going in with negative leverage for a period of time until you can kind of level off. And one strategy that we've looked at is buying a rate cap of SOFR at 2%, 3%. So your SOFR plus 3.5 could start off at 5.5%, 6.5%, and you're fixed for 2 or 3 years, artificially fixed with that rate cap. I think based on the forward curve, I wouldn't go more than 2 years on a current deal with the floating rate cap. The caps just don't pay out. They're not forecasted to pay out as much as they have the last 24 months. That being said, the pricing of them is coming down. So if you have a deal coming up for renewal and you're looking to buy another rate cap, I would wait as long as possible. Craig mentioned he has one coming up June 24th. I think rate caps will be cheaper, generally speaking, cheaper in the future than they are today. Like I said, we have a deal in Q4 coming up for rate cap renewal for 1-year extension. I price that out on a regular basis, and I anticipate waiting September, October before pulling the trigger on that. And that same rate cap should be much cheaper. Does anybody have any current deals they're looking at? debt on, if you want to go in the chat box and drop us some information there. We'd love to see what we're looking at here. Or what deals you're underwriting or looking at, and what types of debt you're looking at. On every deal our acquisition team and I work on, they find a deal, they kind of narrow it down, and then we circle up on it. We look at all options of debt, starting at your agency fixed rate debt, always the best option. If I can get a 5, a 7, or a 10-year fixed rate, let's do it. Generally speaking, currently agencies are limiting proceeds on newer deals. So you can be 55 to 57% loan to value. That's pretty low historically. Hopefully we get back soon to a time where you're 30 to 40% equity, 70% leverage. I think it's a good number overall. We're not there yet. You may be at a higher spread, but those deals don't make a lot of sense. So we look at agency fixed rate, agency floating rate, life company deals. Life companies can do 5 or 7 year deals, perhaps 10 years, a little bit lower leverage than agencies, maybe the 55%. And then your bridge options are 2 to 3 year deals, anywhere from 60, 65, maybe 70% leverage on the right deal in the right market. Those require rate caps, and they're currently expensive. So make sure you're factoring those in. Some strategies going forward. Like I said, if you have a rate cap coming up for renewal, I would wait as close as possible to the renewal date. And I think that rate cap extension or purchase for an acquisition will be much cheaper in the future than they are today, significantly. The one I previously mentioned was about $1,950,000 a month ago. By the time Q3, Q4 roll around, I expect that to be less than $1 million. I'd be surprised if it's not. So you can buy a rate cap for an extension anytime, up until your date of extension, obviously. So it doesn't hurt to keep your tabs on prices as you go forward and find the time that works best for you. Banks are limiting supply. I did see that Q1 this year had the highest amount of bank loans ever, but I expect that to tighten going forward. With rates, bank rates are more based on prime, Wall Street Journal prime plus or minus. Usually they have some SOFR deals too. With rates in the 7s to 8s, your buyer demand dries up quick, and your seller prices are still elevated. Hopefully seller expectations on price come down with these longer sustained higher rates that we're in. If seller expectations kind of come down over time and your loan rates drop from 7 to 8 back to 5 to 6%, I think the market's going to be very strong. And that's where I expect we are in the next 6 to 12 months. Does anybody here have any current multifamily deals they're looking at buying or looking to invest in, or any questions about multifamily debt? You can go ahead and drop those in chat and we can get to those as we can. Some strategies going forward for us, for Multifamily Investor Nation. We're actively looking at deals. Our acquisition team scrubs over 1,000 deals a year at a high level, filters down. A very small percentage of those deals currently make sense due to either seller expectations of price too high, debt being too high, or another factor. On a lease-up deal, a new deal where the seller is just building occupancy, those have limited debt options. The lenders kind of take a risk that you're going to finish leasing it up, and typically those are bridge deals. Let's see. Craig says, do you see doomsday scenario coming for multifamily firms like Texas? that was $1 billion company. So for them to lose a property is probably not the end of the day. It's not a good day. I'm assuming somebody got fired over that deal. But I think over the next 12 months or so to 18, 24 months, a lot of these deals that were previously 2 to 3 year bridge deals 2 to 3 years ago will be coming up for renewal. And bridge renewals, you have to buy an additional rate cap. And then sometimes they're subject to DSC test or debt yield test, which are cash flow based. I think there's going to be a lot of properties where the lenders choose not to renew the loans because either the properties don't hit their debt yield covenants for renewals, they don't hit their DSC covenants for renewals, or the buyer hasn't reserved adequate capital to purchase the additional rate cap. These are things you have to look at well in advance. Like all loans, bridge loans are, each one's custom and each point is negotiable. So on all of our bridge loans, 2 to 3 year deals, I always like to make sure the first extension is, I say free, is not debt yield DSC tested. We basically would just buy another 1 year rate cap and be good for another year. Rate caps are expensive, but at least it's better than running out of options for refis. If you have a deal that's doesn't currently have the NOI cash flow you think it should, and your current lender doesn't want to renew it, your options are going to be very limited. There's probably not a lot of lenders lining up to loan on bad deals. I think that might be time to look at a sale. And there's some opportunity there. Back to Craig's question, I think there's going to be some opportunity where you have more motivated sellers the second half of the year into 24 because of a maturity, loan maturity, debt yield or DSC test, or they just can't get the refi they need. So if you have some capital reserved, I would sit tight and look for opportunities later this year into next year. There's some funds that are taking advantage of that as well. I've seen a couple of emails about rescue funds, loan funds that are going to these assets and offering them to refi the debt at a higher rate. And that's my robot vacuum. Let me turn that off so it's not making noise here. 1 second, sorry. You never want predatory loans. They're going to be a higher rate, just not good for anybody. I think in those cases, maybe you just sell the asset, take your equity and call it a day. Hopefully you wouldn't be in that situation because you watch our podcast or our webinars and you learned to get in front of this stuff. Reserve enough capital for your rate cap extension, price it out on a regular basis so you're not caught off guard at time of renewal. To back up a step, when you did your bridge loan, you could have negotiated the extensions to be no debt yield test, no DSC test. You got a more favorable term that way. Some bridge debt has extension fees. Typically, your 311 being a 3 year floating rate with an additional 1 year and 1 year options. It's 5 years. Your 311s would have a 1/4 point to a 1/2 point extension fee for the 4th and 5th year. Your 2 111s, again, 5 year deal, 2 years initial term, followed by 3 1 year options. A lot of those, your first extension does not have fees. Go ahead and renew into those. But hopefully, our plan is to eventually, with the market corrections and rates coming down, to get all of our assets into somewhat of a fixed rate debt, 5, 7, or 10 year fixed rate debt. It smooths out cash flows. Once rates are lower at a more historical average as rates, 4.5%, 5%, 5.5%. I think that makes a lot more sense. And we're close on agency rates. It's just proceeds. The deal was previously purchased at 75%. Now you can refinance at 60%. Have you made up that gap from NOI growth and value growth? I'm guessing value's gone down the last couple of years based on a lot of industry broker opinions of value that we keep tabs on due to cap rate expansion. So any other questions debt wise, or any questions from any of our folks here watching? Any current deals you're looking on, you have any questions about? Let's see. Paul has a 24 unit property. He hopes it will appraise for $3.5 million next fall. If I cash out refi at that point, what LTV do you think I can get? 70% unrealistic. Let's see, 24. That's 100, 145, 150 unit, not bad. I think 70% is reasonable given no larger macroeconomic problems. A deal that size, I would start with a regional or community bank is a good bet. Somebody you currently bank with or have a relationship with. A couple factors there. Your purchase date. If you just bought it, you're looking to cash out a year later, possibly not. If you've had it for a couple of years, had some growth, you've done some rehab or grown your rents, you have a story behind creating value. I think you have a much better chance of getting a 70%-ish a cash out deal. I think if you can show any lender ever that you've added value to an asset, be it by growth, growing rents, comps, the market doing well, I think you have a significant case for getting a higher number there. That is about all the talking points I have. So if anybody has any other questions, we'd love to address those in the chat box. Otherwise, I hope to see everyone at the Multifamily Investor Nation Conference in Charlotte, June 12th to 14th this year. Let's see. Paul's bought in 21. He's grown rents. That's a great thing. Bought in 21 for about $730 a month. Now leases are $1150. So you've had significant gross lease income has grown. Directly affects value as long as you control your expenses. So hopefully that deal works out for you. Keep us posted. Keep coming back to these webinars and let us know how that deal works out for you. I would say, well, wait until 24. So go ahead and look at it now. It never hurts to look at refis, and maybe a different lender than you currently use is my suggestion there. So if we don't have any more questions from our folks here, we're going to wrap it up. I thank you for your time and look forward to joining us next time.